to go through the day because I don't see any safe trade to take. Yesterday ended with a bull channel, which is a bear flag. First bar of the day, strong bear bar, probably okay short. There's room to the bottom of the tight trading range from yesterday. Second bar of the day, bull reversal bar. There's room to the high, so it might be okay. My concern is a very large bar down, very large bar up. The market's probably going to go sideways, so you're playing musical chairs, and the music will probably stop very soon. The market will start chopping in here. Okay, so the bulls were able to make a scalp there. Now you can argue slightly lower high, double top. What about shorting here? There's no way I'm going to short that. Really large bars forcing me to short at the moving average in the bottom half of a tight trading range. Can't do that. Okay. Bar 4, you can argue, higher low, let's go ahead and buy. I make the point fairly regularly when I see this. When you have a very large signal bar and you have a bunch of overlapping bars and it's at the moving average and the entry price is at the top of the trading range, it's almost always a bear trap. I mean a bull trap. So I would never buy that. If anything, I would short on a limit order up there. Okay, inside bar on bar 6. What about shorting below it? It's kind of near the top of the trading range. It is kind of near, but it's not at the top of the trading range, so it's not a good short. 7, outside bar. So now you get inside, outside. Next bar might be inside again. What about just simply entering on a breakout above or below the bar? Well, you got 2 doji bars here, outside bar, and you got a bunch of very big bars and lots of reversals today. So I'm going to tell you that I think it's a trading range. And if it's trading range, do you want to be buying at the top of anything? And the answer is no. And do you want to be shorting at the bottom of anything? And the answer is no. So you can't be entering on a breakout from that outside bar. Okay, next bar I think is interesting. You have now an OO, outside, outside. You have an outside bar on 7, and then 8 is even a larger outside bar. I think the bulls are running into problems here, especially by the close of this bar. The market's starting to accumulate large bear bars, and that's selling pressure. And we're right above a tight trading range, which is a magnet. So I'm assuming that the market's going to come down into that. It's risky to be shorting at the bottom of the trading range that we've had today. But if I'm going to short, I like to short below strong bear bars. So if I'm going to do any trade right now, that would be the one I would do. Market drifted down, not too strong. 8 was was basically a spike down, and then down through 12 was kind of like a little parabolic channel. It broke out below the tight trading range of the final couple hours of yesterday, and now it's forming a 2-bar reversal and a little wedge bull flag. Tough call on it. I didn't buy it. Maybe I should have. The entry bar was strong, no tail, bottom or top, good sized body. I thought there were going to be shorts at the moving average, but this bar was pretty strong. Follow through on bar 15. I'm not going to short that low one. I've been trying to make this point more often because there have been questions in the recent few weeks about low ones and high ones. And so here we have a fairly good bear spike, okay? But a low one short needs 2 things. It needs a bear spike and it needs a bear trend. This has one of the 2. And unless it has the other one, unless it's clearly a bear trend, I don't want to be shorting a low one, and chances are it's going to fail. And traders who buy at or below the signal bar probably will make a scalp. Okay, 17 went outside up, and I thought about buying above it, especially given the failed low one, but I didn't. And I was probably too cautious. I mean, look at 17 and then 18, small tails, big bodies. The market at this point is probably always in up, but you still have the problem of trading range out to the upside. Okay, 20, a bear reversal bar at the top of the trading range, when we broke out of the bottom, the market reversed up. Maybe breaking out of the top, the market will reverse down. Even though it's a good-looking bear reversal bar, we have way too much momentum going up, and I think the odds are there will be buyers below. I think if you're going to buy, you can place a limit order at or below that bar, and probably another one at the moving average, and have your stop way down below bar 17. Anyway, the market set up a high 1 at 21, and I did not buy it because it was a doji bar at the top of a trading range. But to me, always in probably went long on 18, and once always in is long, you can pretty much buy anything. You can buy below the low of the prior bar, above the high of the prior bar. You can buy, a 2-point pullback, a 4-point pullback, test of the moving average, and you can just keep buying for any reason at all, as long as the always in position stays long. Okay, another really strong push up, 22, 23, but it's another buy climax. 14 was a buy climax, 17, 18 a buy climax. This is the third buy climax, and we're up in the area of a trend channel line and an expanding triangle. The market might start to pull back. Okay, doji at 24, and then one more push up. A lot of times, doji is a pause and then one more push up. So a lot of times that's climactic and leads to a two-legged correction. The close of 25 is below the midpoint, so it meets the minimum criterion for reversal bar, and it's at a trend channel line. But the channel is so steep that I would only look to buy. I would not be shorting. If you are going to short, I would not short below bars. I would only short above bars. Okay. After such a steep move up, I think it's reasonable to look for a couple legs sideways to down and maybe try to buy at or near the moving average. So that means that the II at 28 is probably going to fail, and I think if traders wanted to, they could be scaling in shorts, and then if the market forms a high 2, reverse to long. But scaling in shorts, I was scaling in above the highs of bars and above swing highs. We had the morning trading range, even though it was only about an hour or so. It was a continuation of the trading range from yesterday. So that's enough of a trading range for the market to, I think, enter a trending trading range day. And as such, it probably will come down and test the 58 area, the breakout point at some point. We don't know yet if the top of the range is in, but we do know that it will probably test down to the breakout point, 57.5, 58, somewhere in there. Now, 34, you can argue, it's a high 2. Al said that, if you're going short, you buy back at a high 2, but it's also a tight trading range. So in general, when I see that, I wait to see if a wedge bull flag sits up. And it did with 37. 3 pushes down, 26, 32, and 37. I went brain dead and I didn't buy it. And I think I even talked about it. I forgot. I was distracted with something and I don't remember what it was. That was probably my dumbest move of the day, not buying above that. Okay, strong spike up. The bodies are increasing in size, so the momentum is picking up. And then you have a bear inside bar and a possible final flag here. And remember, trending trading range day, we're in the upper range and it's been trading up. Trading range day trades up and down. So somewhere around here, the market should start to trade down. And it turned out that this was it from the final flag in the bear inside bar. Possible lower high at 46. It's a micro channel breakout, but the market's getting pretty close to the moving average. I really should have been more aggressive with this. I knew the market was going to hit 58. I should have just held, shorted and held short for the test down. Okay, low 2 at 50, right at the moving average. It's a bear channel. In general, I don't like to short below the lows of bars and bear channels.